Hello, hope you're doing well. This is Patrick Bartolotto. I wanted to start today's lesson by covering the idea of creating financial statements. So I'm going to walk you through the whole process from the creation of a business and cover a bunch of steps, but through the creation of all of our financial statements. We're going to process transactions and we're going to create, at the end of the day, a balance sheet and income statement. So that's our main goal. Let's get right into it. I want to actually emphasize I'm going to cover 5 kind of general steps here. And the goal here is that the creation of the financial statements aligns with just the creation of a business itself. And this is important because the assumption here is not just about accounting for accounting's sake. It's that why and how does the non-accountant, the individual not training to be an accountant, not an accountant, et cetera, still need absolutely to understand how accounting is, as the language of business, just going to reflect the transactions happening. And so the best way to do that is to work through the whole financial, a whole set of transactions that will use together to build financial statements. And this matters for this reason. I would argue, what are the 2 main things you want to think about as a non-accountant to still understand accounting? Can I understand the business event transaction by transaction? Like, what things am I going to engage in when running, organizing, conducting, being a part of a business? And then finally, what are the final financial statements that reflect all of that? And the importance of that is that most people don't talk or get involved in the creation of transactions or journal entries in accounting, but many of us are affected by the end results of financial statements, whether it's through projections or valuation or analysis or allocation of capital, or really whatever else. So with that, let's go through these 5 steps quickly, then jump into the whole process here. First thing I'm going to do, and what I try to do here is be as parsimonious as possible with the transaction. So please don't, skip some of these around. Like, I only need a couple. All accounting is the same. It really isn't. And what I try to do is just get each core idea and represent it with one transaction. So generally speaking, with the adjusting general entries, it might be 1 or 2 that kind of cover a similar idea, but in a different way, which is important. But really trying to get at each core transaction, you could see it as a business. How do you process that? Now, is there more to accounting? Of course there is. Of course there is. But the goal here is to get at all the main ideas across in a transaction sense. You can say, how does it affect things? Importantly, as I go through these, I'm going to talk about how they affect assets, liabilities, and equity, and then the specific account. So what we're leaving out of this process is the traditional tools of accounting used by accountants. We're not going to be using debits and credits. We're not going to be using the strict format of journal entries, although we're definitely still abiding by that. And we're not going to be using T accounts or T charts, as people call them. So none of those are going to be used here, not because they don't matter and not because this isn't consistent with that. But the thought here, again, the approach, when a couple of other professors asked me to make this is for an audience of non-accountants, just sort of, mentioning over and over again, I think actually across the board, 3 different departments individuals from are kind of asking hey, how do we get our students to get more accounting? So this is a kind of a hope that many people can use this. So how do we get our non-accountants to understand what's going on and how the business is reflecting accounting itself? So let's go through these. First step, transactions 1 through 3. What are the ways we could raise capital and how do we account for that? Second one, now that we have the capital, and I'm assuming we've been able to get it, right? In step 1, how do we deploy that capital? I'll show some things we can buy with our capital. Are these complete lists? No. Do they cover every aspect of accounting? No, of course not. Every possible scenario? Of course not. But they're designed to cover each main category. So you could raise, let me go to deploying capital, raise equity capital, raise debt capital. It doesn't mean that every company will do that. But I want to cover all the main ideas, all right? Deploying capital, what things could we buy with our capital? Certainly more than this, but I want to get that conversation started. And then running the business. And so I broke that into 3 categories. We're going to talk about earning revenue through conducting our business, incurring and recording expenses. Those will be transactions 10 through 12. You can see all my transactions here. And then additional factors like collection from customers and payments of bills and other things like that. In many ways, these 3 in the middle there, the routine transactions we're going to engage in running our business. Step 4 is going to get slightly kind of wonky. It's the idea of adjusting journal entries. And in accounting, the other transactions are kind of just straightforward. When you see it, you process it, you have the fact set, the invoice, something like that in front of you. Adjusting journal entries are really the point of them is, if I can kind of start off by talking about that, is to recognize that there's business events that might occur in the background or as time goes by, or before we close our books, we have to account for those as well. So that's the goal of adjusting journal entries. We'll cover those as well. And then finally, once we're done that, we'll finalize our balance sheet and income statement and make sure we can actually go about preparing the rest of our preparing our financial statements. So with that, let's jump right into it. I want to be clear. Alongside this, I've created this Excel template. It's a template I created for my MSTC program. I'm following a similar format. This was entirely created to do the similar process to make sure that we could see and cover all the areas of accounting. I know this is probably small, and it doesn't matter if you can't see it because I'm going to make it bigger as we work on step by step. I was just trying to capture the whole thing here. But we're actually going to carve it up and work on certain things. Just to kind of give you a general idea, and the specifics really don't matter. On the column to the far left, we're going to see that we have our accounts, list of accounts, and those are both asset, liability, equity, including our temporary accounts, and I'll cover these as we go through it. In the middle, which is blank right now, that's where we're going to process our transactions, and I split it assets and liabilities to get some organization. And then at the bottom there in blue, and you probably can't see it, that's okay, there's like a little check row, and that's just to make sure that if we make a mistake, we know it up front. So this is a worksheet, hopefully you have access to. It's just designed to work alongside this. Is this like the only thing you could use? No, it's another tool that does this. You can actually do this entire lesson though without the worksheet. Just know that if you wanted to do this yourself and get your hands dirty practicing it, you might want to throw this into a worksheet. You could do this by hand. I just think you'll probably make fewer math mistakes, adding and subtracting and that kind of stuff if you throw it into Excel. That's the benefit of it. And then it naturally tracks everything by account. So we'll cover that. And actually, I'll show you how that can create a balance sheet and income statement at the end. But again, this is tiny. You don't need to read all this. I got all my columns in there, kind of in the middle. That's where I'm going to process my transactions. And then I've got some adjusting balances, unadjusted balance that I'll cover that as we go through it. But just kind of know we're eventually going to fill this out. If you have a little bit of background in accounting, I would argue that you could think of this kind of like not literally, not exactly the same, but like a general ledger, kind of a combination of a general ledger and a trial balance. So those are accounting tools. And if you don't know what I mean by those two things, you're fine. You're not behind at all. But it's kind of a way of doing that in a simplified manner. Of course, for a real company, we wouldn't have 21 transactions, right? We'd have tens of thousands, if not millions. But 21 transactions is kind of getting all the core ideas without repeating the ideas at any point in time. All right, let's keep going here. My first one is raising capital. I got 3 transactions. I'm going to process these one at a time, so you don't have to worry about keeping track of them. I'll keep each one in mind. Kind of going back to Excel, you don't need to figure out all that stuff, but we'll slowly work on it. Let's do the first one. And I'm just giving you the answers here. I want to talk through it. It's not really what's the answer. It's the process. If I could emphasize, I want you to focus on what's the process. Why did we do it? Not what's the end result. The end result is right there. So at the beginning of the year, the company raises $300 in equity, right? How do I process when a company raises equity? Common startup, kind of any stage company, different ones would have this. But what do I do when I process, when we go out and we raise equity? Well, what happens when you raise equity? You're going to go and raise cash, right, and give up ownership, equity, whether it's issuing shares or issuing forms of equity. We're not getting into the legal structure of this, but what are you saying? People out there want to become my investors, my equity investors. I'm giving them the opportunity to be equity investors in my company, and they're giving me in exchange for that cash. So that's what I have here. Don't worry about my numbers. I'm just choosing numbers to make this work, and then also so that they're all different so we don't lose track of things. But this isn't a comment about, $300 represents anything. The numbers are made up. The process is absolutely real in the essentials part here, right? So we're going to increase our assets 300, and we're going to increase our equity. Sorry, I should have started here. This all is going to build off the idea of assets equal liabilities plus equity. That's the accounting equation or the balance sheet equation. Not to imply in any way that the balance sheet's the only thing we need, but it's the way actually we want to think about processing transactions. So we still care about the income statement I'll bring in later, and of course, a statement of cash flows. Specifically, we're trying to assess things like liquidity, right? You really want to think about cash flows when you're talking about liquidity. But when you're talking about what does the company have? What does it owe? And what does it earn? What does it have? Its assets. What does it owe? And liabilities. And what is the ownership structure? That would be on my assets, my liabilities, and my equity. Right? We're going to start there with processing transactions, and I'll show the other statements a little bit later. So again, assets equal liabilities plus equity. If I raise equity 300, I'm going to increase my equity 300. I'm going to increase my cash. Increasing my equity, there's more owners out there, and they've given me cash. So my cash goes up, my equity goes up. I'm going to call this, in this case, contributed capital. The specific term you use here is not super important, but I do want to be clear as I put in parentheses. That's an equity account. So kind of the parentheses E, I and many others use that. That means equity. The parentheses A means it's an asset account. What I'm doing here in these different lines, right, is just to remind us of how this all works together. So the general equation is assets equal liabilities plus equity. The second one is what's happening overall assets are increasing, equity's increasing. And the third one saying which specific accounts and amounts. So I have it all there. And I won't recover that for all of them. I just want to make sure we're clear. With that, I've processed my first transaction. Ready to go to the second one? Let's do it. All right, second one, raising debt. Now, to be clear, actually, a colleague of mine kind of pointed this out. Early stage companies may struggle to raise kind of debt. I'm not saying that this implies that you should, or this is certainly not a comment on optimal capital structure. I'm not getting into that kind of stuff right now. These are great conversations, but not in this intro level. Our goal here is just figure out, okay, if we raise debt, then how do we process that transaction? So what do we have here? Beginning of the year, we raise $120 in long-term debt. It bears an interest rate of 10%. Just keeping my numbers easy. Don't put too much in my 10%, except that that's a nice one for me to multiply. Increase assets, one. So we're going to have the same equation, not recovering that. Increase assets, 120, and increase liabilities. Why? What did I get? I got cash here, my third row of 120. So cash, the asset account goes up by 120. And my long-term debt, a liability account goes up by 120 as well. I have more cash, but I have an obligation to pay off the bank for this particular loan. That's why I have both sides of that transaction, right? The idea of the balance sheet balance is just representing like what's actually going on at the business. All pieces, not an incomplete representation. I do have more cash, but I also have a liability outstanding. I now owe that bank for the amount that it lent me, $120. All right, it mentions interest there. Let's jump into this. I'll kind of ask a question, give you a second to answer it, and then we'll cover the answer. Should we think about interest expense at this moment? Do we need to do anything about interest expense? The answer here is going to be no. No, because time hasn't passed yet. And we will cover interest later. So, stay tuned. Something to look forward to here. But we're not going to cover interest right now. We're not going to cover interest right now because we're going to assume that this is just when we obtain the debt, we get the cash. We don't owe interest yet. We definitely need the passage of time to think about incurring interest expense, right? So we need the passage of time that hasn't happened yet. Generally speaking, we're going to wait for like an accounting period, which could be a month, a quarter, or a year. We say the passage of time, like it's not a split second. We don't record interest expense every fraction of a second. But if you said, hey, did a month pass, a quarter pass, or a year pass, we could. But right now we're saying just this transaction. So we will take care of it. We're not going to take care of it right now. Let's move on to the third one. All right, third one. I have a similar situation as the second one. Hopefully you can start to see some similarities here. The one change I made is it's short-term debt, not long-term debt. So companies can raise money with different horizons when they have to pay it back. In this case, we're saying they have to pay it back short-term, which would be, a year or something around there, less. And long-term could be 5, 10 years, etc. So in this case, it's short-term debt. It's $100. I'm just changing the numbers so we track them all a little bit more easy. We're going to increase assets, cash one more time, and we're going to increase a liability, in this case, short-term debt. Why would we separate these on the balance sheet? Well, because we're arguing they're fundamentally different in their core economics. What do I mean by that? Long-term debt could have a different interest rate, and it does, and it definitely has a different horizon, like time in which we have to pay it off. So on our balance sheet, which we haven't seen yet, but so you get the idea as we start working on this, we're going to start to separate out accounts if they're economically meaningfully different, right? If they're the same, it's just a repeated transaction, the same thing. We're going to put that in the same account on our balance sheet. But if they're different, we're going to make sure that we actually say, wait, this is different. I want to separate short-term debt from long-term debt because the horizon is different. All right, there I've processed that third one. Now I want to jump into my Excel. So I made this a little easier to see by just pulling the snippet that you need right now. This is what I have. I got all my accounts. Hopefully you can read these now. I got all my accounts in that first column, and then I have my year one beginning balances. Just to be clear, I started this company. Well, it's a fictitious company, but so all my balances are zero. Yeah, you're not going to see this for any publicly traded company, but like you yourself starting a business could actually have to have a row with a bunch of zeros in it, right? Once you're public, zero chance you're going to see actual zeros, like true starting point. But just so you know, every company builds from like a starting point of zero at one point in time. Most are well beyond that now. That's why I have all those zeros. They're just populated. I'll show you when they come back in later. But then I have my next columns, the columns with 1, the 2, and 3. Those are my transactions 1, 2, and 3. I'm going to fill them in right now. We actually already did the work. I'm just going to kind of show you the answers and then talk about them. So remember those 3 transactions, 1, 2, and 3. They correspond to columns 1, 2, and 3. So what do I got here? In column 1, I'm just going to repeat them, even though we just covered them. But I think it's worth the practice. What do I have here? I'm going to increase cash. I'm actually increasing cash on all these and keeping it simple to start things off. And I'm going to be increasing my contributed capital. You'll see the assets are on the top half-ish and the liabilities are on the bottom half-ish with equity. So I've got my liabilities and equity on the bottom half. My contributed capital is an equity account, so that's going to go up for the first one. My long-term debt's going to go up for the second one. My short-term debt's going to go up for the first one. Cash increases in all ways. You'll see the change to assets and the change to liabilities and equity. Those are equal for each column, each transaction, which is actually why my check, assets minus liabilities plus equity, is going to balance to zero. I created this Excel file so that if you made a mistake, it's going to make that check row, it's going to say something other than zero. So as like a reminder to yourself, if that check row says something other than zero, there's a mistake you have to correct. Right now, I just entered these in. You could do cell references and stuff like that. That's perfectly fine, which actually would reduce the chance you're going to make a mistake. But what we want to show here is that means everything balances. So if my assets go up and my liabilities plus equity go up by the same amount, everything's going to balance. I got no problem there. All right, good on that? So this is the way I input them into Excel. It's not more or different transactions. It's exactly the same as what I covered. I'm just showing if I talk about the transaction one at a time, and then how do I translate that to my Excel worksheet, which is like kind of my general ledger at this point. All right, I had an error in the slides. I had to quickly fix that, actually go through them all, and then realize I had to redo it. So let's just jump right back into it to get going here for the second round. I'll hopefully get it right here. But we have 3 transactions here that are going to cover our second stage of running our business, deploying our capital. And not in any way to imply that this is the best or the only way to deploy capital. And we're certainly not getting into assessments of capital allocation, which is a great topic. But just how do we make sure that we understand the representation of the business or economic events transaction by transaction, and then ultimately how it affects our financial statements as we begin to deploy our capital in different things in our business. So let's jump right into it. We're going to start here with transaction 4. So what do we do in transaction 4? The company pays $60 for a year of insurance coverage starting halfway through the year. So what are we going to have there? We're going to decrease one asset. It's going to be cash. We paid $60 cash. We're going to increase another asset, which for $60 each. And what we're going to do, cash goes down $60. We're going to use this term other assets. And I'm going to introduce that because it's a great example of how we're going to see some aggregation of accounts on our balance sheet. So we don't see every possible scenario a company could have, enter into, do business with, listed as its own account on a balance sheet or an income statement. We're going to see some degree of aggregation. I want to introduce that topic here. Insurance, right? This is going to be what's called a prepaid expense, where we pay in advance, and we're going to decrease our cash, but we're not actually recognizing it as an expense yet. We're just recognizing it as an asset because we still have value in this. We still get the coverage in the period going forward. And this is an essential part of accrual accounting, as a lot of these transactions are attempting to represent here, which is that we haven't used anything up. So we don't recognize an expense. Even though we spent the cash, it's basically a transfer of one asset. Using our cash to buy another asset, insurance coverage, right? We're going to call the insurance coverage, we're going to categorize them, under other assets, just because it likely wouldn't be a standalone line on a balance sheet. But importantly, I want to represent this core idea is that we have situations where we're going to spend cash, we're going to obtain assets, but we're not going to expense them or think about that as some decrease or bad thing. It's simply transferring. So less cash, but more of something that's beneficial for us. Insurance coverage, right? That's our first set here. So we're going to decrease cash. We're going to increase another asset. There's going to be no effect on our liabilities or equity at this point in time. Now, later we'll talk about what happens as the period goes by and we use up the coverage. But right now we've just transferred an asset, right? We spent cash. We received another asset. This would be the same in many other situations. Let's jump into our 5th transaction here right now too. We purchased $210 worth of inventory on account. So, okay, what do we have here? We're going to go and purchase inventory. We're going to increase our inventory account because we have more inventory. And importantly, even though we didn't pay any cash yet, accrual accounting says we have to represent the economic or business reality of what happened. And what's the business reality of what happened here? Well, we have inventory, but now we owe money to our suppliers for that. They didn't give it to us for free. They're expecting something in the future. And so what we have in this case is we're going to recognize a liability. We commonly are going to call this liability accounts payable. So accounts payable representing that we have an obligation to a supplier. That's the basic idea of a liability, expected future sacrifice. So what's happening again? Assets are going up, inventory is going up. And on the other side of the balance sheet, our liabilities, in this case, accounts payable, are also going up. Even though we haven't paid, we have received the inventory, we have to represent the economic reality, right? The business or economic reality that we have an obligation there. That's what we have in this situation for 5. Let's jump into 6. We purchased $200 worth of equipment to use in our business. We pay 20% down, and the rest is on long-term debt with the equipment seller at 10% interest. And just keep my interest rates simple here, not a commentary about what they should be. No additional payments until the next year. So what do we have here? I just want to set this up by stating the following. I'm going to make sure this journal entry is going to have 3 parts, right? 3 parts. Journal entries have to have a minimum of 2 parts because you have to have balance. And that's not an accounting thing. That's more of business activities. You're going to have like multiple, more than one side. We want to represent the fullness of that, not just an incomplete representation. So yes, the balance sheet balances, and yes, that's a good thing because we're acknowledging that like business or economic reality. That's what we're trying to represent here. All right. So what do we have? First, I'm going to say, and the order in which I process these is not important. It's just that we represent the full thing correctly. So we have all the pieces, all the amounts. That absolutely matters. But, throughout all of these, if you thought about processing this in a different order, transaction by transaction than I do, you're not wrong. There's nothing wrong about that at all. There's no design way to say that, these must come before, these parts of the entry must come first. I don't want to emphasize that at all. All right, so let's jump into it here. What do we have? We're going to decrease our assets $40. That's the cash we put for the down payment. We're going to increase the asset of $200. And if you reverse the order of that, that's fine. Keep going. You're doing the right thing. And then we have to do what on the other side of the equation? We have to balance it. But more importantly, we have to represent the economic reality. We have to represent the economic reality that we didn't get the $200 of equipment for just $40. We have an obligation, which is going to be in our long-term debt of $160, or basically the balance. So what do we have here? Yes, we did get equipment. Yes, it's worth $200. We paid $40 in cash at this time for a down payment. We still owe $160. Much like transactions 2 and 3, I'm not going to worry about interest expense at this moment in time because time has not yet progressed or passed. So yes, I'll cover that later when we have like the ending of the accounting period. But right now, you don't have to worry about interest expense. It's just recording the receipt of this equipment and then the fundamentals that we paid some cash. So cash goes down. The rest we still owe. So a liability needs to go up. All right, jump on the way we're looking at these. So this is what we've actually done. Hopefully you remember that we process transactions 1, 2, and 3, and we've got them up here already. I'm just filtering in now 4, 5, and 6 the same way. So those are the ones we just covered. Let's just jump into it. We have the 3 and 4, 5, and 6, the buying of the insurance, and 4, the purchasing of inventory on account, and 5, and then the purchasing of equipment with both cash down and the liability. And the one of these I want to talk about here is other assets. So other assets I want to emphasize because that was our insurance. What if we called this prepaid insurance? What could we call this something else? Yes, absolutely. But I'd be surprised if you ever find a company that lists every line on their actual balance sheet. Instead, you're going to see something like this, other assets, like an aggregation account. Actually, many small things could go into that account. I'm not going to go through all of them because I'm trying to keep this set of transactions as small as possible to cover all the core ideas and out of respect for your time, but still covering all the main concepts. But there could be a variety of other things that go into other assets. So you could put other, supplies in there. Anything if you prepaid rent in the same way to insurance, you could put other things into that category. In this case, I'm just putting insurance in there to just show the idea that not every transaction is perfectly represented, word for word as a balance sheet thing. We're going to aggregate some stuff there. Okay. That's what we have in that case. I want to jump to our third section, and there's going to be 9 transactions here. We talk about running our business. Here, I'm going to focus on revenues, just to kind of cover this idea first. And I want to emphasize what we're doing here with the revenue transaction. So let's jump into transaction 7. Transaction 7, kind of start with the most easy possible, though actually extremely rare transaction. We're probably not going to see that often once we really flesh it all out. We're going to sell $95 worth of goods to a customer for cash. So what do we have there? We're going to increase our assets. We're going to increase our cash account, and we're going to increase our equity. But in this case, it's going to go into revenue, right? So revenue on its own, right, is going to increase our equity. So the more we earn from providing goods and services to our customers, the more value we've actually created for our shareholders. And so all else held equal, of course, we're going to have expenses. I'll cover them later. I'm just not covering them right now. So if you're also thinking that isn't there inventory and cost of goods sold in this transaction, you're right, but I want to just focus on revenue for simplicity, which is actually done by companies at times too. Not that it has to be done that way, but just focus on revenue. We'll cover our expenses later. What do we have here? We've increased cash and we recognize revenue. What's happening? We've provided a good or service to our customers. We want to recognize that by increasing our equity and increasing our cash. Okay, that's a straightforward transaction. Let me do transaction 8. We sell $255 worth of goods to a customer on account. So it's actually similar to the first transaction 7. I'm sorry. Similar to the first transaction where assets are going to go up and equity are going to go up. The difference is really just which asset account. In this case, instead of increasing our cash, we're going to increase our accounts receivable. So if you've heard of it before, awesome. If not, let's talk a little bit about accounts receivable. What are accounts receivable? It's an asset account that represents cash collections we expect from our customers from prior sales on account. And so this is actually a really essential idea of accrual accounting. Even though we didn't collect the cash yet, we want to make sure that we represent the expected future cash collections here. And that's what accounts receivable are. We didn't collect the $255 of cash yet, but we expect to collect the $255 of cash in the future. That's what it means when we increase our accounts receivable account on the balance sheet, an asset account. Also, we definitely get to recognize revenue because we're not waiting for the actual cash collection to recognize revenue. We're looking for the business or economic action of providing the goods or services. This is an essential idea of accrual accounting. If we were following cash accounting, we'd say nothing happened here. But that's just not true. That's not accurate, right? So we want to say that, no, you actually did conduct business. You provided goods or services to your customers, represent that, but you haven't collected yet. So you have to represent that too. And that's why we use accounts receivable. It's a good time to kind of introduce this idea. I don't know if you've heard people who have a very, I'll say, interesting, arguably dated, kind of oddly out of touch perspective on accounting. And they usually talk about accounting as like just representing the past or focus on the past. And when you hear people say that, my best advice is run away, because that's a person I just worry that they don't really have an understanding of how businesses work, which I think is kind of important here. And here's why. It's in simple transactions like these. What are accounts receivable? Accounts receivable are the expectation of future cash collections. And so accounting is absolutely a forward-looking, forward-focused thing. Does it include transactions from the past? Yes, it does. Is it forward-looking even in the most common elements? And there's actually even more advanced applications of this where much of accrual accounting is actually designed to do this, to help us predict future cash flows, to help us predict future business events. And we're seeing that right here. The increasing of accounts receivable is specifically designed to give us a roadmap for future cash flows. So if you are a person interested in cash flows, if you know people who talk about cash flows, valuation, discounted cash flow valuation models, here's kind of an extra point here, but you know they're sincere in what they're saying if they're really, really thoughtful and good at understanding accrual accounting, because cash accounting can't predict future cash flows. Think about it. Cash accounting would say nothing happened here. But accrual accounting says, yes, two things have happened. One, revenue's been provided and earned. Let's recognize that. And also, the cash has not been collected yet, but let's recognize through accrual accounting the expectation of future cash flows. So accrual accounting is representing not only the core business being represented here, but also it's getting at the specifics of giving us a roadmap for future cash flows. So we want to make sure we do that. All right. Let's jump into the next one. My son joined us for a second there. All right. The company, I went the wrong way, actually, this way I wanted to go. That's okay. The company collects $90 from a customer in advance of a sale. I actually want to put these two together because it's similar but different. In this case, we are collecting the cash up front, right? But we're not actually providing the goods or services yet. So we did collect the cash, but we didn't provide the goods or services yet. So how do we deal with that? We're going to increase our assets, our cash account. But importantly, another aspect of accrual accounting here, kind of representing the business or economic essence of what's going on, not just kind of skipping over things that just looking at cash flows might do. We're going to emphasize that we have an obligation. We have cash. We don't get to keep that cash, just because we stole it or something like that. We have to recognize we have an obligation, deferred revenue, meaning we have an obligation to provide our customers with goods or services at some point in the future. So this is another essential part of accrual accounting, is representing that like collecting cash is not the same as earning cash. And if you're into valuation, those kind of things, this is so essential. You want to make sure that your cash flow models are based on cash that's earned, meaning accrual accounting, not cash that you've kind of just taken. Now, I'm not saying this company's involved in some sort of crime here, implying that in any way, but it's like, I want to wait until you earn. earn it through business actions before, even though I've collected it here. So how do we do that? I'm not increasing my equity here. I'm not saying my shareholders are better off. I'm representing the economic reality. I do have cash, fact, but I also have a liability, an expectation to provide the customer with goods or services in the future. That's what I have here. All right. That's my next three. Let's jump into this. Same idea, pulling them into my worksheet in Excel. I'll probably spend a little bit less time on each of these because it's the same idea, and hopefully you get to see that here. There's my set of transactions, and here's what I have in 7, 8, and 9, my last three columns with the burnt orange border around them that I put in there. First one, increased revenue 95, increased cash 95. Second one, increased revenue 255, same impact on equity, my temporary account of revenue. Right, that's going to go into my equity account. I'll cover that when I do the closing. And then that one, though, I didn't increase my cash yet. I'm just going to be increasing my accounts receivable. And finally, my transaction 9, I have collected my cash in advance, but I haven't yet earned it. So I don't have anything in revenue. It's worth noting the difference there. I have a liability to reflect the fact that I, the company, have an obligation to provide a good or service to my customer in the future. Okay, let's jump into my next set. This is still in part 3, running our business. I've just intentionally separated revenues and expenses. So could you do these together? Yes, of course you could. I just think for learning purposes that it might be easier to split them out. That's the only reason I'm doing these. All right, so we have 10, 11, 12. Let's go through each of these. First one. Company determines that inventory worth 170 was used up in a sale to its customers. Again, at times you could process this right with the revenue transaction, but that's not a requirement. I'm showing kind of what would happen if you didn't do that. So what do we have here? I'm going to decrease my assets. I'm actually going to decrease my inventory 170, and I'm going to decrease my equity. Specifically, now's the first time I'm going to recognize an expense. So an expense is going to be represented as a decreased equity. Effectively, I'm recognizing that my shareholders, that resources have been used up, and therefore my equity, my shareholders' perspective is going to go down. All else held equal. I'm not saying it's a bad idea because I would have revenue associated with this too. So you really want to look at them all together, all your revenues and expenses. You really don't analyze a company by looking at one at a time. But I want to represent this. Expenses, all else held equal. It's reflecting that resources were used up or expected to be used up, and therefore I have to decrease my equity to represent that. In this case, I called it cost of sales. You could also see this referred to as cost of revenue or cost of goods sold. So that specific term is not the big point here, but it's a component. It's a temporary account. An expense account is a temporary account. It's a component of equity. Resources were used up. I want to reflect that reality from the perspective of my shareholders. All right. 11. Similar thing. These are all going to cover expenses, although I'm going to vary which expenses they are. So we incur and pay $70 of research and development expense. What do I have here? I'm going to decrease my assets. This is going to be decreased to cash because I said I'm incurring and paying it, assume at the same time. And then I'm also going to decrease my equity, much like I did with cost of sales, except this is a different expense. It wouldn't be called cost of sales, it would be research and development expense. So I decrease my equity by that amount as well. Okay, similar thing. Equity is going down because to reflect the shareholders' perspective of resources being consumed, and cash is going down here as well. My balance sheet balances, I'm still always using the assets equal liabilities plus equity equation, right? Transaction 12, let's jump into this one. We incur $50 worth of marketing and selling expense for the work that employees did in the period. This has not yet been paid. Good. So in that case, I'm actually going to say I have an expense, my decreased equity, marketing and selling expense, as I call it here. But on the other side, actually, I want to recognize that I'm not using up an asset at this moment in time. I'm incurring or taking on a liability. So what am I reflecting here? The expense has been incurred. That's the expense side. My employees have worked and I owe them. But importantly, I have not paid them yet. So instead of decreasing cash, which I would do when I pay them, I have to still represent the economic reality of I owe them. I have a liability to my employees. I need to represent that liability. So I need to be thinking about that I will owe them cash in the future. So I was talking about this with accounts receivable and the prediction of future cash flows. This is the same thing. How do we in accrual accounting use payables? Well, they're a reflection of future cash outflows in this case, right? So what is accrual accounting? If you really get the chance to understand it, I mean, if you're interested in cash flows, spend as much possible time on accrual accounting. I mean, the amount of time you spend on cash flow is fine. Play around with it a little bit, get to know those pieces. Valuation, the same thing. It's mostly just emphasis, just a reflection of accrual accounting with some additional things to learn and master along the way. So that this is your free cash flows, your outflows effectively, your future cash flows, your future cash outflows. Is you have a payable in this case, which I'm going to say wages payable, the amount that I owe to my employees, but I have not yet paid. I want to reflect that by increasing my liability on my balance sheet. Okay, those are my three sets, just expenses of it. There's my Excel worksheet. I'm going to continue to populate that with these. Let's jump into it. The first one, I have the inventory being used up, so the asset goes down. The second one, I'm paying in cash, so that asset goes down. And the third one, which is different, all three of them are expenses. They all have the same effect, obviously different dollar amounts, but the same effect on my equity. Expenses bring equity down. They're in my temporary accounts. I'll talk about how temporary accounts are closed to retained earnings at the end of the period, but don't worry too much about that yet. But importantly, in the third one, I don't have an outflow of cash yet. I don't have an asset being used up yet. I still need to represent the economic reality that I have wages payable, so I increase that liability. Everything balances, everything checks. I'm good to go. Let's jump to our next set here. 13, 14, and 15. Let's go through these. First one, 13. We collect $65 from a customer who previously made a purchase on account. So this is technically related to, what would that be? Transaction 10, I think. If I'm wrong, I apologize. So what do we have here? We're going to decrease an asset. Which asset? Accounts receivable. And if you want to process this in the other order, please go ahead. Accounts receivable goes down and cash goes up. So the order of saying which one happens doesn't matter. Why? What are accounts receivable? My expected future cash collections. What's this? One of those, actual cash collections. So my accounts receivable, the asset account, goes down as I'm collecting, and my cash is going up as I'm collecting. So I'm representing both parts of this economic transaction. There's nothing on the other side. Importantly, I'm not earning anything or creating wealth here. It's why we have accrual accounting. We care about the creation of wealth, and cash flows don't represent that. This is just a collection of cash. I created the wealth when I provided the good or service. This is just the kind of the bookkeeping. The cash flows are a good example of like bookkeeping stuff that you want to make sure you take care of. That, hey, this represents a collection of cash, but not the earning of anything. I've already taken care of the earning of stuff in transaction 10. So I collect cash. Cash goes up. Accounts receivable, which was my expectation of future cash collections, goes down by the amount that I actually collect. All right. Transaction 14, what do I have here? We pay $48 of the amount we owe to our employees. So this does go with the other transaction that I just saw, transaction 12. So we're going to decrease assets. That's going to be cash when I actually pay my employees. And I'm going to decrease my liability. How do we decrease our liabilities? Well, we settle them. But how do we settle them? We settle them by just making good on them, right? We're giving the cash to our employees. Now, I just made it in this case that we didn't pay them in full yet, but we will. That's not to say we're, trying to run any scam on them, but it just represents that as we pay our employees, we both decrease our cash as we pay them, and we get to decrease the liability for any amount that we did pay. Wages payable represented future cash outflows that we need to have to compensate our employees when we eventually pay them. And this says that the liability goes down as I make good on those payments as I have here. All right, let's jump into 15. Excuse me. In this case, we're saying, and you kind of assume at the end of the year, we are going to pay down all of our short-term debt, including the interest that it owes for the year. So for the year, meaning like we held it basically for one full year, and we're going to represent this. This relates to transaction 3. Not that you need to have remembered that, but if you're curious, and I put it in here so I didn't make a mistake. What do I do here? Well, I need to consider there's actually kind of two things that I'm paying for. I'm paying the principal $100, but I'm also paying interest I've incurred for the year of having the debt outstanding. So my cash goes down by $100 of principal plus $8 of interest. And $8 of interest, that's why I made my number symbol. It's $100 principal times rate, 8% times time. It's just 1 year, or some would say 12 over 12 months, equals $8. So my cash goes down by the full amount of 108. My long-term debt, that's a mistake there. It should be short-term debt. My short-term debt, I guess I didn't fix that when I was covering it, but my short-term debt is going to go down by $100. It's going to be right in my Excel. It's just not right on the slide. And the transaction does talk about short-term debt. My short-term debt goes down by 100, and my interest expense is going to be recognized as an expense. That's going to decrease my equity by $8. All right, let's actually show that in Excel and talk about it, which is the following. So I do have that correctly in the short-term debt row, which is one above the long-term debt. In addition, my 3 transactions, Cash and accounts receivable, when I collect cash, cash goes up, accounts receivable goes down. No effect on equity because collection of cash is not a creation of wealth. It's just a necessary transaction, but not a creation of wealth. We did that in the prior transaction. That was transaction 8, actually. And then in transaction 14, we're going to be showing that we have wages payable going down, my liability, and I'm going to have my cash going down as well. And finally, in transaction 15, my cash goes down by the 108 and my short-term debt goes down by 100, and my interest expense, the expense I incurred, is going to be recognized as well, decreasing my equity. Those are my final sets of kind of running the business transactions. So with that in mind, I'm actually going to jump into completing our adjusting journal entries. And just for simplicity, I've split this into parts 1 and 2, just to process 3 at a time and not trying to process 6 transactions at once. So let's go through 16, 17, and 18. What do we have here? So a good classic example of an accrued adjusting entry is like the entries that occur in the background. They're ones where we probably aren't using cash. We may not even have a transaction right in front of us, but we still have to understand that business is occurring even if it's not right in front of us. And we have to represent that reality. Utilities expense are a good idea, right? We haven't paid the bill yet. We may have received the bill, but and therefore we know that the utilities have been incurred even though we haven't paid them yet. So what do we do here? Let's say we now realize that for the period, whatever it is, we have utilities expense. I need to increase a liability to represent that. I'm going to call that liability accrued expenses. This is a great time to mention, like, the exact name of this is not important. If you, for example, wanted to put this in accounts payable, that's really fine. That distinction is not an important one at all. I always get people who make a big fuss about it, but if you're not actually an accountant, it doesn't matter. But we do need to represent as this reality. We have a liability, right? Assets, liabilities, and equity are so important. Sometimes the name within those categories is not as important, but it's absolutely important to think about this as a liability. We have had the expense, we've benefited from utilities, and we haven't paid for it yet. So we must represent a liability to reflect that economic reality. I'm going to call it accrued expenses, meaning expenses incurred and not yet paid. That's like a good category to put this in. I'm just also offering, it doesn't have to be in here. You could have also, for example, called this utilities payable, right? But I don't have that on my list of accounts on the balance sheet. So I'm still going to stick with accrued expenses, representing expenses incurred and not yet paid. But accrued expenses is a liability account as I have here. What's the other side of that? I have to represent the shareholder or equity perspective of that. Because those resources were consumed, I have to show that my equity is going down, all else held equal. So I increase a liability of 22 and I decrease my equity to represent the shareholder side of an expense. My equity is going to go down by 22. 17. What do we have here? Similar in many ways. Going back to our insurance coverage, what do we have? We bought it kind of halfway through the year. And so we're saying that, hey, we used up half of it. It was a $60 policy. So if we used up half of it, I'm just keeping it simple, we're going to recognize that $30 has been used up. So what do I do there? Remember, this went into other assets because I put it in other assets. When I'm recording that it's been used up, I need to decrease other assets by the $30. So other assets goes down by 30, and then I recognize an expense, general and administrative expense, for $30 as well. So my equity goes down and my assets, in this case, other assets, go down as well. So my expenses are showing either obligations I have to pay or make good on in the future if I recognize a liability, or they're going to be associated with using up an asset as I have here. My insurance coverage was initially $60. I used up half of it. So now I have $30 that was used up and $30 remaining. I have to reflect that economic reality. All right, transaction 18. Let's jump into this one. We realized that we had provided $48 worth of services to the customer who prepaid in transaction 9. So what do we have in this situation? Well, we want to recognize that we have our liabilities, deferred revenue, is going to go down by $48, and we're going to increase our equity by $48. Why? This is us earning. So this is when we get to increase equity. The shareholder perspective of this is, as we provide goods or services, we're going to recognize revenue, But in this case, we don't collect or expect to collect because we've already collected in the initial transaction. So when we initially collected the cash, we recognize a liability, deferred revenue. We're going to take that deferred revenue liability and decrease it as now we're settling our obligation. We're settling our liability because we provided them the goods or services. What we're really saying here is like we realized that you could say that we realized we had provided the goods or services. So during this accounting period, we provided the goods or services. We're reflecting that economic reality here. Revenue is being recognized, equity is going up, and my liability is going down because it's not a liability anymore, or not for that amount. I have settled it. I've provided the goods or services. I actually shifted a little bit, so this is probably worth pausing and talking about here. I basically have in my first column unadjusted balances. That is actually the total of all transactions 1 through 15. You can't see them because this wouldn't fit on a slide. I was kind of pushing it anyway, but that's basically that's just a column that represents for each account across my balance sheet. All of the total effect on those accounts. So that's a column that's totaled that all up. It was actually, as we were working, it was doing that, although I wasn't showing that in this presentation, but it was just Excel. I'm just saying sum this row to be this. And what I want to talk about now is transactions 16 through 21 is what I'm going to call my adjusting entries. And I want to talk to you about what's there at the end, the adjusted balances. Now, to be clear, the adjusted balances are exactly equal to the unadjusted balances because I haven't recorded my adjusting journal entries yet, 16 through 21. But as I do my adjusting journal entries, my adjusted balances are going to kind of update across this. So they'll start to update. And then when I'm done, all of them, meaning through 21, that's all we're going to do here. Then we would actually see that the adjusted balances are different from the unadjusted, and really the adjusted balances are the correct ones. So unadjusted is more of what an accountant would see. Adjusted is going to be like the final ones we're going to use and talk about. But let's keep going on these next three here. All right. So what do we have? And you can see for some of these, the ones that are changing, my adjusted balances are now beginning to not equal my unadjusted balances. But what do I have? My first three adjusting journal entries. 16, I'm going to recognize that I had utilities expense goes into general administrative. 17, I'm also going to have general administrative for my using up of insurance. In that case, an asset decreases. And then 18, I'm going to recognize revenue that I've earned, have not yet recognized, but I'm doing that here, decreasing my liability deferred revenue. All right. Got our last three transactions to work through. This does end at 21. Thanks for being patient and working along all this. And please don't quit soon, right? Because like the 21, I was really trying to get all these transactions without repeating anything. And hopefully this is valuable. But don't just say, hey, I got 3 or 4, I got the hang of it. No, I mean, you don't have to do each of these transactions 40 times, but each 1 through 21 is kind of representing a different idea. I want to emphasize that one last time here. So let's jump into 19 here. What do we have? We recorded our interest expense for the year on the $120 of long-term debt and the $160 of long-term debt for the equipment. Interest has not yet been paid, but this is a core idea of accrual accounting. Even though we haven't paid the interest, we have to reflect the business or economic reality that's been incurred. So what do we have? First, I'll talk about where I got this from. My total principal outstanding is 280. 280 times 10%, I kept my math simple, times 1 for 1 year, right? It's going to give me $28 of interest expense incurred because I borrowed $280 across these two things. I kept the interest rate the same to keep this simple. You could do 2 separate calculations here if you wanted to. And that's going to lead to $28 of interest expense. So what do I have? Because I haven't yet paid it, that's important. I have to increase my liability. So there's no change to cash yet. And I'm going to decrease my equity. I'm going to decrease my equity the same way I've talked about with other expenses. So I'm going to increase interest payable, my liability associated with interest that's been incurred and not yet paid. And I'm going to recognize my decrease to equity via interest expense. So interest expense, interest payable, what am I using here? Just generally speaking, terms that make sense. The amount I still owe, that's my interest payable. The amount of recognizing the expense, the effect on equity, that's going to be my interest expense. I need both of these. I want to be clear about that, right? We're trying to reflect the fullness of it, which is that I still owe, and I'm recognizing that the expense has been incurred. And so accrual accounting represents both of those aspects. That's why we have a balanced balance sheet and have multiple parts to journal entries and processing of transactions. All right, that's 19. Let's jump to 20. We are getting close. The company reports depreciation expense for the year on its equipment. $200 equipment has useful life of 20 years, no residual value. Some terms there, I'm just keeping this as simple as possible. Obviously, those are ultimately important if you move further along in accounting. But I'm going to start at the bottom, I guess, for a second. The 200 divided by 10, 20 years is going to be $10 a year of depreciation expense. And that's like my first calculation that I'm using. I'm really trying to keep these numbers simple for myself. But what does that do? That's going to decrease my assets and decrease my equity. So the equity impact is going to be the same as I've talked about with many expenses. What's the effect on my shareholders or my equity of expenses? It reflects that the expenses are kind of showing the resources are consumed. All else held equal, the shareholders have less. Again, not that they're bad ideas. They would always be offset with revenues and everything else. But the shareholders have less as expenses are being incurred. The other side of this is a new term. So, and this did appear on my balance sheet. I'm using accumulated depreciation. It's basically a way of tracking depreciation over time on the balance sheet. It's technically called a contra asset account, but that's not super important. It's just more that we have my property, plant, and equipment. That's the primary account. And attached to it is an account we call accumulated depreciation, which is where we accumulate all of our depreciation expense over time for the particular type of property, plant, and equipment. All right. So went the wrong way. Let's jump to this next one. So I actually wanted to start off here saying that we can't do transaction 21 yet. We're going to have to stop. Transaction 21 is a good example of like a last or near the end adjusting journal entry. What are you going to do here? We need to think about, given that we had, or if we had profits during the year, what is our income tax expense or income tax burden expected with that? Even though we haven't paid it yet, we still have to recognize that during the year, if we had profits, we incurred income tax expense on those profits. So as I say there, we have to first solve for income tax expense before we process this transaction. So this last one is going to take a little bit more time. What do I have here? In my Excel worksheet, actually, as I've been doing this, I could either naturally or step by step, start to populate my income statement. And the little income statement I have is kind of like what would have been done to date. But I'm not done yet because I've got my revenues, my cost of goods sold, my gross margin, my various expenses, my operating income, my interest expense, and my income before taxes. I still need to include tax expense. Well, I could basically populate that here as I've done my bottom calculation or with my bigger version of the income statement. If I have $10 of income, and I intentionally made these easy numbers for myself, times 20% tax rate, I'm not debating what rate we should use. Just assume that's the applicable rate for our company. And that's going to give me $2 of income tax expense for the year. So what do I do with that? That's going to populate my income statement, and it's actually going to help me determine net income. So what's net income? Let me work through my income statement kind of quickly here because we're talking about it. Revenue minus cost of goods sold or cost of sales is going to be my gross margin. Gross margin minus all of my other operating expenses is going to give me my operating income. So you think about your gross margin as like how much money do you make just considering the cost of the product itself? Operating income is how much money do you make after you consider all of the core recurring operating expenses. And then beyond that, we usually get outside of operations. You could have one-time gains or losses, or you could have things like interest expense, which is not an expense directly related to my operations. It's more related to the way that I finance my business, the fact that I have long-term and short-term debt. Ultimately, what am I going to do there? Then I get income before taxes. My tax expense, as we just showed, is $2, gives me my bottom line net income. What's net income? Revenue minus all expenses, whether they're operating or not, gives me my bottom line net income, in this case of $8. We're still not done. We have to go back and take this information to the transactions that we're still processing. So now we have our data, though. We learned that our income tax expense is $2. So what do we do here? We have to increase our liabilities $2. Why? We didn't pay the tax burden yet, the amount owed to the IRS, let's say. So we have to increase our liabilities. Which liability? Well, the one that fits, taxes payable. That liability goes up $2, but we still do the same thing we've done with expenses. We have to reflect that the expense, on its own is going to decrease the value for my equity holder. So tax expense is going to be my decrease to equity. Taxes payable is going to be my increase to my liability because I haven't paid it yet. And good news, that's it. We've processed all our transactions 1 through 21. Our goal was to show an array of different common things and talk about a bunch of concepts that we have. Just to finish it off, I need to populate my Excel with those transactions, and I'm able to do that here. I'm going to throw in there my interest expense. I'm going to throw in my depreciation expense, and I'm going to throw in my taxes. Throughout all of these, the specific order in which I process the transactions is not essential, but there was some sense to the idea of 1 through 15 kind of coming first, 16 through 20 kind of coming next. And then it's going to be easiest to do your income tax calculation once everything else is done. So like finishing your adjusting journal entries with an income tax expense calculation is just not a requirement. I just think that will make things a little bit easier. I would recommend that in general. All right. So good news. My checks work. My changes to liabilities and equity equal my changes to assets. And I've actually at this point populated all of my adjusted balances. What does that mean? Unadjusted means before any adjusting journal entries. Then I had 6 adjusting journal entries, 6. So I'm going to actually say that my adjusted balances reflect all of that. What do I do with all this stuff? We can finalize our balance sheet and our income statement. So we have to do this one extra process here. And I don't think this is super important for accountants, except it's worth, non-accountants, sorry. It's worth noting here, even for accountants, this is kind of done with software anyway. We have to close these temporary accounts. And I'm going to show that visually here in the retained earnings. But the simple way to do that is if you look at kind of my brighter orange column right there in the middle with the closing heading, that just means we take all of our revenues and expenses, we literally offset them. So it just equals negative whatever. We literally offset them so they go to 0. But we can't just do that. We have to bring in the total or net effect. And so the total or net effect is going to be what my $8 is retained earnings, that's my net income. That's not coincidental. My total impact of revenues and expenses are going to increase my equity via increasing my retained earnings, $8. So that bright orange column is just the literal closing. What really matters here is that they all go to 0. And then my retained earnings takes the total or net balance. So retained earnings increases by $8. Here's what I want to emphasize about this process that's important for non-accountants. It's not doing it. It's not doing this process. It's understanding that this is exactly what enables the articulation of my income statement and my balance sheet. 1, so they fit and they work together. And 2, so they're not redundant to each other. We have 3 financial statements, 3 main financial statements. The statement of cash flows, the balance sheet, the income statement. They all tell different things. They all do so differently, and that's great. There is no one best financial statement. Anyone who's offering that fundamentally doesn't understand things like valuation, businesses, financial statements, etc. I would be worried about that person. But importantly, they work together. They show different things. And that's valuable because collectively, this is not an intro to analysis, financial statement analysis, et cetera, which is absolutely a topic I love. Collectively, we learn more by putting them together, but they show different things. We're going to close my temporary accounts off of my balance sheet because, as you can see there, they don't go there anymore. They're actually there temporarily during the year, only as we record transactions. But at the end of the year, basically, I'm not saying this is the prettiest balance sheet you could ever see. It's just taking my work in the worksheet and showing how that would be reflected in a balance sheet. So what do I have here? My beginning balances were all 0. Remember, we started from true scratch. And then my ending balances for the balance sheet are going to be there. I've closed all of my temporary accounts in to retained earnings. And so retained earnings carries the net or balance of those. It doesn't list them all separately. And here's why. Guess what we were able to do? We already did this, but I just want to bring it back up. The income statement. So the income statement is where I would put my temporary accounts with some degree of aggregation and also some additional subtotals like gross margin, operating income, et cetera. So I have all of my temporary accounts, revenues and expenses listed on my income statement. I have all of my permanent accounts, which includes retained earnings, the total or net effect of my temporary revenues and expenses listed on my balance sheet. They're not redundant, importantly, and they articulate together well because the change in retained earnings is my net income for the period. So the balance sheet and the balance sheet and the income statement articulate together. It's not today's topic, but there's actually a similar logic you can work through with the statement of cash flows. I'm just not going to cover that in this session. So that's it. I'm going to wrap it up with a few quick comments, but hopefully this works out. So again, what was the goal of all this? To make sure that you can process and understand business reality, economic reality, transaction by transaction, and then think about how does that translate to financial statements. Congratulations to you. If you're able to do this, you created your first set of financial statements. My goal through transactions 1 through 21 was to give a depiction of a core, common, recurring idea without being too repetitive. So yeah, make sure you covered all of these. Hey, I just skipped around and covered 6 or 7 is not a good way to do this. You don't need to do each one 45 times, but make sure you do understand each of them. Less so about what's the number in my Excel worksheet and much more about, wait, why did I represent it there? And I want to reuse this phrase one more time. What's our goal of accrual accounting? What's one of the goals? To represent the business or economic reality, all sides, all pieces. So if we work through this, it's very logical. It's what's happening at a business. That's what drives accrual accounting. Second thing, a little bit behind the scenes here, I'll be honest. Accrual accounting is designed to give us a mapping of future cash flows. Certainly, there are tons of people who are interested in future cash flows, and I want to tell you, what is your roadmap? What's your roadmap for future cash flows? Accrual accounting, we did a little bit of that here. There's actually a lot more. A lot of the more involved treatments of accrual accounting are really, how do we make sure that we have a really good mapping of future cash flows? And how do we, with accrual accounting, make sure we completely depict the business and represent the wealth created during that period from the perspective of our shareholders? All right, that's it. I'm going to wrap up. Patrick Barbalato, hopefully this was valuable for you, whatever manner, professor, class, whatever you're taking and working this on. Take care of yourself and enjoy. Importantly, I'm always abiding by the balance sheet equation. Assets equal liability.